Andrew Stotz of Stotz Investment Research. And today I'm going to talk to you about value investing icons. In this, I want you to learn about value investing. Who are the 8 icons who started the field of value investing? Where did the dividend discount model come from? And many other things. Now, the sources for this presentation I took from many different places. First, here is the site, which I've put the link in the final page, just value investing, famous value investors. This is from Investopedia. Here you have it. There's the link. And the next one is value investing in Wikipedia. I took some information from there. And also in Investopedia, I took some information from Warren Buffett's Investing Style Revisited. And of course, my library and my brain. I got a big library behind me. I've read many, 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 many books on finance. But before we talk further, let me introduce myself. My name's Andrew Stotz. I have a Ph.D. in finance, and I'm a CFA charter holder. I have a 20-year career as an equity analyst and a head of research, and I've been teaching valuation over that time. I was president of CFA Society Thailand for 2 terms, and I founded my own investment research company, Stotz Investment Research. I also founded the Valuation Master Class. It is the most comprehensive online course for learning how to value stocks. I try to include in this class everything that you need to know to succeed in valuation. In it, you'll learn how to forecast, you'll learn how to value companies, you'll be using the financial model I developed over the decades. If you like it, copy it. In addition to forecasting and valuation, students learn how to present and debate their investment research. The class is a step-by-step program that takes you from a beginner or intermediate skill level to mastery of stock valuation. We provide you with the same professional valuation tools used by institutions around the world, and we teach you everything you need to know to use them. Now, let's talk about value investing. All right, the first thing is, it's the idea that you can achieve superior investment performance through buying shares of businesses at prices below the intrinsic value. The origin of the tools to perform the analysis comes from Benjamin Graham and David Dodd's book, Security Analysis. 1 second. And there you have my original version of it, Security Analysis, and it had all the ratios and everything in it. And this one was printed in 1988 is when I got that one. I later updated it and got this one, which is a little bit older, I think, but not by much. 1988, so same, but I like the soft cover. So that book was written in 1934. An investor tries to estimate the intrinsic value of a business through a variety of means, such as price to book or PE, tangible asset value, discounted cash flow, or free cash flow value. Now, there's 8 men considered either founders or supporters of value investing: Benjamin Graham, John Burr Williams, Irving Kahn, Sir John Marks Templeton, Walter Schloss, Warren Buffett, and Christopher Browne and Seth Klarman. Let's start with Benjamin Graham. He was born in 1894 and lived to 1976. He's called the father of value investing. So his famous books are the one I just showed you, Security Analysis, and also The Intelligent Investor. This is my version of the book that I got a while ago. I think this one came out in 1984. And that's where I learned a lot about valuation. And in the old days, there wasn't a lot of books that I could find. So I remember the first time I read both of his books, and it was pretty exciting. It was about 1993 when I stumbled upon him and really, really got interested. Graham developed the idea of buying a stock below its intrinsic value to limit downside risk. He observed that stocks often trade at prices in the stock market that do not reflect their intrinsic value, and that this is where the opportunity is. Graham's techniques inspired Warren Buffett and has formed the foundation of Buffett's investment strategy. Graham worked as an investment manager and as a lecturer at Columbia University. The next guy, now this one is a little bit more unknown, and I searched out to find his book many years ago when I was teaching finance. And here is a copy of his book, The Theory of Investing, of Investment Value. Now this book has lots of charts and graphs and lots of illustrations, including also algebra, which was one of the reasons why the book publishers didn't really want to publish it. It also has case studies in the back, like Consolidated Gas in 1930. So it's a little bit old style, but I loved it. I loved it because he was the one that really talked about discounting of future dividends. So let's talk about John Burr Williams. He was the first to deeply demonstrate the concept of intrinsic value derived from future cash flow. Benjamin Graham was often looking at the balance sheet and some other items like looking at a margin of safety, but John Burr Williams looked completely to the future. He published that book in 1938 based on his Ph.D. thesis. In it, he mapped out the theory that valuation should be based on discounted cash flow. In fact, there's my Ph.D. thesis. It didn't get published as a book, but it is about it's called An Empirical Study of Financial Analysts' Earnings Forecast Accuracy. My professor really wanted to give it a really fancy name, but basically it just shows that analysts have a hard time forecasting. So, from 1927 until his death, Williams worked in the management of private investment portfolios and security analysis. He taught economics and investment analysis as a visiting professor at the University of Wisconsin-Madison. He also wrote many articles for economic journals. Today, his privately held investment management company, Burr and Company, LLC, is run by his grandson, John Borden Williams. And yes, you can actually go to this website and you can see it. Not much there, but you can send an email to his son. Now, some of the quotes that I liked from his book: separate and distinct things not to be confused, as every thoughtful investor knows, are real worth and market price. What a breakthrough that he was talking about at that time. He changed the focus to the underlying components of asset value rather than just price trends or a random walk. Williams proposed that the value of an asset should be calculated using evaluation by the rule of present worth. So he was the one that really started talking about the present value of future cash flows. Thus, for common stock, the intrinsic long-term worth is the present value of its future net cash flows in the form of dividend distributions. And of course, you also get selling price at the end of the period that you're holding it. His approach made him a pioneer in forecasting financial statements. You see, Graham didn't have to forecast so much. He was looking at the balance sheet right there at a point in time. He did some forecasting, but John Burr Williams had to do it. And since his method was based upon this, rather than on some multiple of P&L or balance sheet. All right, let's talk about Irving Kahn. Here's one of his book, Benjamin Graham, the Father of Financial Analysis, that he put together as an occasional paper for the Financial Analyst Journal. That's the CFA journal. I've got some links in this slide that you can see where I got the picture and the book. He lived from 1905 to 2015. That's a pretty good life. And he was Graham's teaching assistant. He started working on Wall Street in 1928. Remember, that was just before the crash. And along with Graham and other investors, founded the New York Society of Security Analysts in 1937. It's a member society of CFA Institute, and you can go onto the internet and find it right now. I've got some friends that are members of that. His philosophy was that the frenzied trading of stocks on Wall Street is disconnected from the facts about the underlying businesses, and that patience in investing is a virtue. He was a conservative investor, holding about 50% of his assets in cash and the other 50% in stock. It's almost unheard of nowadays. He founded the New York-based private investment firm Kahn Brothers Advisors in 1978 with two of his sons, and that firm still exists. It implements a contrarian value strategy focusing on margin of safety and capital appreciation over long periods of time. Contrarian value means they calculate the value, and then they really are looking for bombed out stocks. The managers focus on investments in seasoned businesses in depressed but well-established economic sectors. Kahn Brothers focuses also on small and medium-sized businesses, an area which is known for producing higher returns, though often with higher risk. Let's talk about Sir John Templeton. He was born in 1912 and lived to 2008. He was an American-born British investor, banker, fund manager, and philanthropist. In 1954, he created the Templeton Growth Fund. In 1999, Money Magazine article named him arguably the greatest global stock picker of the century, particularly because he used the word global. At that time, it wasn't that common. In fact, he was investing in Japan long before anybody even knew about Japan from an investment perspective. During the Depression of the 1930s, Templeton did something really smart. He bought 100 shares of each New York Stock Exchange listed company, which was then selling for less than $1 a share. From this, he made his money back many times over when U.S. industry picked up as a result of World War II. His Templeton Growth Fund pioneered globally diversified investments. He attributed much of his success to his ability to maintain an elevated mood, avoid anxiety, and stay disciplined. In fact, many of the books he wrote or co-wrote were about topics related to life rather than investing. His style was to avoid the herd and buy when there's blood in the streets, and to take profits when values and expectations were high. I wonder what he would be doing right now. So, he was a chartered financial analyst also, like me. Let's talk about Walter Schloss. He lived from 1916 to 2012. He worked with Buffett at Graham's firm, Graham Newman. In 1955, he started his investment management firm. He focused on company financial statements and the investment publication Value Line for much of his investment research. In the old days, really the only source of information was a company called Value Line, which provided sheets for each of the companies in the market that gave some basic balance sheet, income statement, and the like. So he liked companies where management owned a major stake, debt was low, and the stock was trading at a discount to book value. He also shorted stocks, which we don't hear much about in the value investors world at times, and also held lots of cash when he didn't see good opportunities. One unique feature was that he diversified to an extreme for value investors, sometimes owning more than 100 stocks. One of the academic papers that I've done basically shows that after you've combined about 10 stocks into a portfolio, at least in Asia was where I looked at it, but I suppose if you look across the world or you look in the US, it's about 10, maximum 20 that you've gotten almost all the benefit of diversification. Now, very few people are going to own only 10 because it's a very concentrated portfolio. What happens if one of them goes down by a lot? You could be crushed. But then the tendency is to own more and more. And the point is, after 20 or 30 stocks in a portfolio, the behavior of a portfolio is going to be a lot like the market. So if you own 100, it's going to be hard to outperform by skill. But Walter Schloss had it. All right, time to talk about Warren Buffett, born in 1930, just during the Great Depression. He was Graham's student at Columbia and later worked for him. Buffett thinks that he is buying a company, not a stock. He loves the statement, "My favorite investment horizon is forever." He became a millionaire at about 30. He follows Graham's intrinsic value approach with little focus on share price. He doesn't really look at that. He sees the stock market as just a place that can facilitate his purchase or sale rather than a reliable source of information about value. He does value himself. He uses a more qualitative and concentrated approach than Graham did. In fact, for all of these value investors, they're trying to assess the value before they even look at the price. If they can do that, then they really feel like the market is just a mechanism where they can enter and exit this stock. Graham preferred to find undervalued average companies and diversify his holdings among them. But Buffett he started to alter Graham's work a bit, and he favors quality businesses that have reasonable valuations and the ability for large growth. Of course, he's managing much more than Graham ever did, and the result of that is he has to invest in large companies. Therefore, he does have to change his tack a bit and look a little bit at the moat that a company has, that the brand that a company has, and he's willing to pay. He considers the business management, financial measures, and the value. He likes companies with high and sustainable return on equity and little debt. He has a strong focus on free cash flow to equity, what he calls owner's earnings. He attempts to estimate intrinsic value using simple earnings forecasts, sometimes based on a growth rate applied to an average earnings per share over the prior decade. Or he could calculate the EPS over a 10-year period and compare the price to that prior 10-year average EPS. That seems so out of date. Most people are going to look at, what's your forecast EPS for next year? He's looking throughout the whole economic cycle. We often call this the cyclically adjusted PE. All right, let's talk about Christopher H. Browne, The Little Book of Value Investing. Now, this one I don't have. Now, you'll notice it's also the comment up there is Chris Browne is one of the best value investors in the world by Barton Biggs, one of the famous investors that used to come into Asia a lot. He lived in Asia for a while. He lived in New York, had a fund there, passed away sadly, but he was a client of mine and he was an impressive guy. But I didn't have this book, of course. I have a lot of others, like The Little Book on Behavior Investing, which is James Montier. That's a great one. He's not one of the icons, but he is a value investor to some extent. Little Book That Beats the Market, or That Makes You Rich. Interesting to see some of the trading methodologies. And then, of course, John Bogle's The Little Book of Common Sense Investing, about investing in ETFs and the benefit of that. And then one that I've really ripped apart and really was the foundation of starting to think about my FVMR investing style, and that is this one, The Little Book That Beats the Market by Joel Greenblatt. And basically he's saying, if you could do a composite score of high ROIC or ROE, let's say, high return companies, and then rank them also on valuation, you'd prefer the ones that are the highest return and the lowest valuation. So let's talk about Christopher Browne. He worked at Tweedy Browne Company, an investment firm founded by his father, Forrest Tweedy, for 40 years. In fact, you can still go to their website and they have some of the research that they've done in the past. I've downloaded some of that and done a lot of reading of some of the stuff that they've published. Tweedy Browne's investment philosophy is based on Graham's teaching. The company serviced many of the most famous value investors. So basically Graham and all of the ones that I've talked about had accounts here and they were buying and selling through this company. You know, they wanted to buy through a company that understood their methodology. The company developed some value funds that have outperformed the S&P. Let's talk about Seth Klarman. Now, he was born in 1957, so he's a little bit younger. I was born in 1965, so he's a little bit older than me. He wrote a book, Margin of Safety, and he's a hedge fund manager who founded the investment partnership Baupost Group. He occasionally holds large amounts of cash and is very risk averse, basing his judgment on a company's liquidation value, which means when the market's super high, he may not be investing at all. He published Margin of Safety, Risk Averse Investing Strategies for the Thoughtful Investors in 1991. I have to confess, I have not read this book, but I want to. All right, let's wrap it up. What have you learned? Value investors try to calculate the intrinsic value of a business and buy at a price below that. It started with Graham and Dodd's 1934 book, Security Analysis. And there's 8 main icons that we've talked about. Benjamin Graham, John Burr Williams, Irving Kahn, Sir John Templeton, Walter Schloss, Warren Buffett, Christopher H. Browne, and Seth Klarman. If you got other icons that you'd like me to talk about, just let me know, and we'll make another video. I look forward to getting your comments.